of Management Studies IGNOU presents an audiobook on the course MMPC 014 Financial Management for MBA program. Presenting Block 5 Emerging Issues in Finance, Unit 14 Behavioral Finance, Part 2. Traditional versus behavioral finance. Now let's try to understand how behavioral finance varies from conventional finance. The rise of behavioral finance has opened up new avenues for studying how investors make decisions based on psychological considerations, as well as new grounds for challenging traditional ways of modeling investor behavior. This field aims to explain how investors' cognitive errors and emotions affect their decision-making. As a result, it differs significantly from traditional finance. The main distinctions between traditional finance and behavioral finance are: Number 1. Traditional finance is based on the arbitrage principles of Miller and Modigliani, the portfolio principle of Markowitz, CAPM of Sharp, Lintner and Black, the option theory of Black, Scholes and Merton, and efficient market hypothesis. Whereas behavioral finance is based on the prospect theory given by Kahneman and Tversky. Number 2. Traditional finance depends heavily on quantitative methods, whereas behavioral finance depends more on psychological aspects. Number 3. Traditional finance assumes that people process data appropriately and correctly. It believes investors are rational and markets generate fair prices close to the intrinsic value of the underlying assets. Whereas behavioral finance believes market participants show irrational behavior. It recognizes that people employ imperfect rules of thumb or heuristics to process data, which leads to biases in their beliefs and predisposes them to commit errors. Number 4. In traditional finance, investors view decisions in terms of risk and returns, whereas behavioral finance postulates that perception of risk and return is influenced by how a decision problem is framed. It assumes frame dependence. Number 5. As per traditional finance, people are guided by reasons, logic, and independent judgment, whereas behavioral finance recognizes that emotions and herd instincts play an important role in influencing decisions. Number 6. Traditional finance argues that markets are efficient, implying that the price of each security is an unbiased estimate of its intrinsic value. Whereas behavioral finance contends that heuristic-driven biases and errors like frame dependence, emotions, and social influence often lead to the discrepancy between market price and fundamental value. And number 7, traditional finance views that prices follow a random walk. Though prices fluctuate to extremes, they are brought back to equilibrium in time. Whereas behavioral finance views that prices are pushed by investors to unsustainable levels in both directions. Investor optimists are disappointed and pessimists are surprised. Stock prices are future estimates, a forecast of what investors expect tomorrow's price to be, rather than an estimate of the present value of future payment streams. Behavioral finance, science or art. Whether behavioral finance should be considered as a science or not is a matter of definition. Simply said, science is a method of observing, documenting, analyzing, and interpreting any event methodically and scientifically. Standard finance, which is a methodical and well-designed subject based on many theories, has been the exclusive source of input for the discipline of behavioral finance. Standard finance theories also aid in justifying stock price movements and trends, that is fundamental analysis, market direction, that is technical analysis, and the construction, revision, and evaluation of investor portfolios, that is, Markowitz's model, Sharpe's performance index, Trainer's performance index, and various portfolio revision formula plans. As a result, behavioral finance can be justified as a science based on this discussion. Art is a very different discipline than science. In science, we follow the rule of thumb, whereas in art, we make up our own rules. Art facilitates the application of theoretical principles in the real world. Certain alterations and aberrations in the theories occur while executing basic finance ideas and concepts. These anomalies are caused by the psychological effects of different users. Behavioral finance focuses on the factors that limit mainstream finance theories as well as the factors that lead to market anomalies. It also assists investors in better identifying themselves by presenting numerous human personality models. Investors tend to organize their funds once they understand the restrictions and cures of their mental setup better. It offers investors a variety of custom-made solutions to use in their financial planning. Therefore, it may be justified as a more practical art of finance. Behavioral finance in the stock market. The efficient market hypothesis or EMH states that stock prices in a highly liquid market are efficiently priced to reflect all available information at any one time. Many studies, on the other hand, have uncovered long-term historical events in securities market that defy the efficient market hypothesis and cannot be captured plausibly in models based on perfect investor rationality. The efficient market hypothesis or EMH is based on the assumption that market participants consider all present and future intrinsic and external factors when determining stock prices. Behavioral finance believes that markets are not efficient when studying the stock market. This allows researchers to study how psychological and social factors influence stock purchases and sales. Understanding and applying behavioral finance biases to stock and other trading market movements can be done daily. Broadly speaking, behavioral finance theories have been used to explain significant market anomalies such as bubbles and deep recessions. Investors and portfolio managers have a vested interest in knowing behavioral finance developments even if they are not a part of EMH. These patterns can be used to analyze market price levels and fluctuations for purpose of speculation and decision making. Decision-making errors and biases. Now let's try to understand some of the behavioral finance buckets or building components. Investors are viewed as normal in behavioral finance, yet they are vulnerable to decision-making biases and errors. At least 4 buckets may be identified when it comes to decision-making biases and errors. Number 1. Self-deception. The concept of self-deception is a barrier to learning. We tend to ignore the knowledge that we need to make an informed decision when we incorrectly believe we know more than we do. Number 2. Heuristic simplification. Another bucket that we can understand is a heuristic simplification. Information processing errors are referred to as heuristic simplification. Number 3. Emotion. Emotion is another behavioral finance bucket. In behavioral finance, emotions refer to our decision making based on our current emotional state. Our current attitude may cause us to make decisions that are not based on logic. And number 4, social influence. The social bucket refers to how our decision making is influenced by others. Heuristics and biases of behavioral finance. The impact of biases is one of the most important parts of behavioral finance research. Biases can be caused by a multitude of factors. When narrowing down on the research or analysis of industry or sector outcomes and results, understanding and classifying different forms of behavioral finance biases can be highly useful. The occurrence of anomalies contradicts modern finance theories that presume rational and logical behavior, yet the existence of anomalies has played a significant role in the development of behavioral finance. Researchers in cognitive psychology have identified certain inborn human qualities that lead to unreasonable and suboptimal decisions, which are referred to as behavioral biases or heuristics. Biases refer to how information is processed to make decisions and the preferences that are considered. These biases are ingrained in human psychology and affect all sorts of investors. Nevertheless, if these biases and their effects are recognized, it is possible to decrease their impact and one can learn to work around them. Cognitive errors, heuristics, mental shortcuts, and emotional biases are examples of these. Biases related to the rigidity of view or cognitive dissonance, such as representativeness, confirmation, conservatism, and so on, as well as biases related to information processing, such as anchoring, mental accounting, framing, and so on, are some of the examples. Emotional biases include loss aversion, over-optimism, overconfidence, self-attribution, self-control, and home biases. Behavioral finance seeks an understanding of the impact of personal biases on investors. Some of the biases that influence investment decisions of investors are representative, anchoring, overconfidence, loss aversion, regret aversion, confirmation, hindsight, herding, mentality accounting, gambler's fallacy, the money illusion, experiential, and familiarity. Let's discuss each of them in detail. Number 1. Representativeness. It is one of the most common biases that involve judging things solely based on how they appear rather than on genuine statistical probability distributions. Investors' proclivity to make decisions based on previous experiences is known as stereotype decision making. Thus, rather than utilizing statistical probabilities, representativeness is the inclination to estimate how likely something is based on how closely it resembles something. For example, investors typically view a company that has performed well over time and has consistently increased profits as a good avenue to park its assets. It is a common misconception that a good company equals a good investment. Many market participants confuse good firms with good stocks. Number 2. Anchoring. Anchoring is a decision-making process in which people's quantitative judgments are impacted by suggestions when they are asked to make them. In the financial markets, investors occasionally make decisions based on irrelevant numbers and statistics. An investor uses the high rate of return attained by a stock in the past as a benchmark for projecting the future return on investment in the absence of pertinent information. As a result, big profits become the primary motivator for investing. It explains why investors prefer to give shorter-term trends less weight and instead focus on recent behavior. Even while anchoring appears to be an improbable phenomenon, it is common in settings where people are engaging with fresh notions. Number 3. Overconfidence. This is usually interpreted as an exaggerated sense of one's own abilities. It has to do with a person's overestimation or exaggeration of his or her capacity to complete a task successfully. It is a sort of bias since it might cause a person's values, ideas, beliefs, or abilities to be misjudged. Although self assurance is a beneficial trait, investors may overestimate their ability to foresee winning investments, ignoring a variety of elements that influence the investment's value. As a result, excessive trading occurs. Males are also more overconfident than females, according to several psychological studies. Overconfidence and optimism combined causes investors to overestimate the accuracy of their knowledge, undervalue the dangers they confront, and exaggerate their capacity to manage events. All of this could lead to an increase in trade volume and speculative bubbles. Overconfidence could explain market overreactions, excess volatility, and speculative asset pricing. It also clarifies why investment professionals keep portfolios in order to pick winners. People give themselves good ratings because they tend to forget their shortcomings and focus solely on their accomplishments. Number 4. Loss aversion. People according to People according to Kahneman, Tversky, Shalev and Rabin experience more discomfort when they lose than the pleasure associated with a similar gain. It was also discovered that when losses and gains are equivalent, people are more likely to feel the agony of loss than the elation associated with gains. As a result, people prefer to avoid losses rather than achieve benefits, which is why the phrase loss aversion bias was coined. When faced with the threat of losing, investors are eager to take risk, but when presented with the prospect of amassing gains, they are less inclined or even unwilling, that is, risk averse. Investors tend to sell rising equities too soon and hold on to losing stocks for too long. Loss aversion occurs when investors place a higher value on the fear of losing money than on the joy of making money. In other words, they are considerably more inclined to prioritize avoiding losses above maximizing investment returns. As a result, some investors may desire a greater payout to make up for their losses. Even if the risk of an investment is reasonable from a rational standpoint, they may strive to avoid losses altogether if the large payout is not expected. Number 5. Regret aversion. It arises from the desire of investors to avoid the pain of regret that may arise due to poor investment decisions. It encourages investors to hold shares that are performing poorly, as doing so avoids the recognition of associated loss and bad investment decisions. Investors can reduce their taxable income by realizing capital losses. Number 6. Confirmation. Confirmation bias is when investors have a bias towards accepting information that confirms their already held belief in an investment. If information surfaces, investors accept it readily to confirm that they are correct about their investment decision, even if the information is flawed. The attribution theory tries to find how people come with the explanations for the causes of actions and their outcomes. Commonly, people judge others on the way they behave. The moment someone is not behaving properly, we tend to believe them as persons of bad character without trying to know the environmental details. What we perceive is not always a true representation of reality. This does not mean that there is something wrong with our senses, but the mind tends to introduce bias while processing certain information and situations. The impression first created is difficult to change. People usually accept and give importance to information that supports their opinion. This type of selective thinking is referred to as confirmation bias. In other words, it represents the tendency of a person to focus on information that confirms his or her pre-existing thought or belief. To overcome this, one needs to find someone who can act as a dissenting voice of reasons so that one is confronted with a contrary viewpoint to examine. An investor may seek information that supports his or her original opinion about investment rather than looking out for information that contradicts it. Number 7. Hindsight. Another common perception bias is hindsight bias, which is all about "I knew it was coming." This kind of bias arises when an individual believes that the event was predictable and obvious, whereas it could not have been reasonably predicted. This can at times result in oversimplification of the causes and effects of the event. It is nothing but a tendency of a person to think that his or her forecasts are better than what they are. In finance, it could be dangerous as investors may tend to remember their success and not failures. Further, they may believe that investment outcomes are more predictable than they are, thus leading to irrational buying and selling of shares, alteration in perception regarding asset allocation and risk exposure. Alteration in perception regarding asset allocation and risk exposure is required. Hindsight bias appears to be prevalent when there are emotional or moral overtones associated with an event. This is true even in the case of an event that is subjected to a process of imagination before its outcome is known. Number 8. Herding. The herd instinct is another market phenomenon characterized by a lack of individuality, wherein people act collectively without thinking or having any centralized direction. This term is generally used to describe the behavior of animals in herds and the behavior of humans in strikes, sporting events, religious gatherings, etc. The term herd instinct refers to a phenomenon where people join groups and follow the actions of others under the assumption that other individuals have already done their research. It happens due to social pressure, that is, a natural desire to be accepted by a group, and the common rationale that such a large group could not be wrong. In our society, we observe that people who meet and communicate with each other regularly think similarly. It is important to understand its origin so that the plausibility of theories of speculative fluctuations that ascribe price changes to faulty thinking could be judged. In investing world, this term refers to forces that cause unsubstantiated rallies or sell-offs. The investor buys or sells just because others are doing so. This behavior becomes prominent during financial crisis, generally associated with the bursting of a bubble. Number 9. Mental accounting. Mental accounting refers to the different values a person places on the same amount of money based on subjective criteria, often with detrimental results. Mental accounting is a concept in the field of behavioral economics. Thus, it is the set of cognitive operations used by the investors to organize, evaluate, and keep track of investment activities. It is the propensity of people to allocate money for specific purposes. By dividing money into different categories like savings, bonuses, tax refunds, etc., it first captures how outcomes are perceived and experienced and how decisions are made and subsequently evaluated. Mental accounting also involves the assignment of activities to specific accounts, and this may help in skipping unnecessary spendings, thus saving money for the future. There is a danger that individuals may keep idle cash instead of using it for repayment of debt or investing it. Number 10. Gambler's fallacy. The gambler's fallacy is also known as the Monte Carlo fallacy. This fallacy rests on the belief that if something happens more frequently than normal over a period, it will happen less frequently in the future, or if it is occurring less frequently over a period, then it will occur more frequently in the future. This results from the misunderstanding of the probability theory. Investors or traders can easily fall prey to the gambler's fallacy that a stock price rising over a period may fall or previous failures lead to a higher probability of success. For example, some investors think that they should sell their stocks as it has been going up for quite some time and they believe that it may go down in future. They may retain stock, the price of which has been going down on some consecutive trading sessions, believing that it is more likely to go up than down in the following trading sessions. Number 11, the money illusion. In economics and behavioral finance, the money illusion describes the tendency to think of currency in nominal terms rather than in real terms. In other words, humans commonly consider money in terms of its numerical or face value, that is nominal value, instead of considering it in terms of its real purchasing power or real value. Because modern currencies have no intrinsic value, the real purchasing power of money is the only true and rational metric by which it should be judged. Still, humans often struggle to do so because derived from all the complex underlying value systems in both domestic and international economies, the real value of money is constantly changing. In the financial markets, many average investors commonly ignore the real value of their currency when valuing their investments or interpreting their appreciation, leading to incorrect perceptions of value and past performance. Number 12, experiential. An experiential bias occurs when investors' memory of recent events makes them biased or leads them to believe that the event is far more likely to occur again. For this reason, it is also known as recency bias or availability bias. Number 13, familiarity. The familiarity bias is when investors tend to invest in what they know, such as domestic companies or locally owned investments. As a result, investors are not diversified across multiple sectors and types of investments, which may reduce risk. Investors tend to go with investments that they have a history or have familiarity with. Quantitative behavioral finance techniques. Developments in behavioral finance. Several developments have taken place since the emergence of behavioral finance. These developments have led to the rise of quantitative behavioral finance, emotional finance, experimental finance, and neurofinance. Behavioral finance is all about what we do. It focuses on the phenomena of how people behave when they are faced with choices. Cognitive finance, on the other hand, look at what is going on within the individual's mind when they make that choice. Here we will discuss some quantitative behavioral finance techniques which use both statistical and mathematical techniques for analyzing behavioral biases and studying their effect on financial markets. Number 1. Quantitative behavioral finance. It is a newly emerging discipline that uses mathematical and statistical methods to analyze behavioral biases and how they affect financial markets. A. Musa and V. Ramaiah Venkateswarlu in 2011 described quantitative behavioral finance as a new discipline that uses mathematical and statistical methodology to understand behavioral biases in conjunction with valuation. Thus, it could be seen as a hybrid approach that reconciles behavioral finance and standard finance. Rigorous mathematical treatment of behavioral finance, especially the setting of continuous time portfolio choice, gives quite unconventional and challenging features for which the known mathematical techniques almost fall apart. It may be so, as behavioral biases and human behavior in general are not amenable to mathematization. So it has emerged as a response to the difficulty faced in translating behavioral ideas in terms of asset prices. This research has been picked up by the practitioners. Number 2. Experimental finance. This is a relatively new field that uses experimental methods to study behavioral biases. By setting up trading simulations, the behavior of investors is examined under a variety of conditions, applying various theories to know how these investors react. This data is subsequently used to predict the possible movements of financial prices under different conditions. It allows researchers to isolate one variable at a time, studying its cause and effect without using econometric techniques to filter the effect of other variables. However, each component or variable can be measured as the difference between the values obtained from surveys and the realized value. Experiments in finance are not the same as those in sciences, as it involves humans having emotions and biases, at times prone to telling lies. Their empirical studies have no specific power as natural sciences. Experimental finance thus cannot be precise as an experimental science. Number 3. Neurofinance. Behavioral finance is based on the prospect theory given by Kahneman and Tversky. Heuristics and biases were limited in explaining the behavior of decision makers in uncertain and risky environments, but failed to explain why and how these behaviors occur. This required study of the human brain, which processes information, the basis for decision making, leading to a new field called neurofinance. It uses functional magnetic resonance imaging or fMRI scans, wherein neuroscientists can identify which brain structures are associated with activities. This technology is related to basic brain processes guiding daily decisions under uncertainty, emotion and social interaction associated with behavior in financial markets. The purpose of neurofinance is to understand how investors make decisions considering different kinds of uncertainties related to the environment and model uncertainty. It is a new kind of behavioral finance used to rationalize price patterns that could not be explained by standard finance. Number 4. Emotional finance. Emotional finance is a discipline that examines how our emotions, both conscious and unconscious, play a major role in all financial decisions. In the investment process, there is uncertainty as well as problems in predicting future outcomes, which unleash feelings of excitement and anxiety. Most theories fail to recognize emotions and their role in the investment process. Markets are viewed as virtual large groups with behavior reflecting the interaction of the often unconscious drives, needs, and emotions of their participants as they deal with the inherent ambivalence and uncertainty of the investment process. Now let's summarize the unit. Behavioral finance is a concept that is very important as an instrument of investment measurement all over the world. Moreover, behavioral finance is superior to traditional methods of investment. In this unit, we have tried to explain the concept of behavioral finance and bring forth its importance. Several psychological factors affect the behavior of market participants like herding behavior, overconfidence, disposition effect, mental accounting, anchoring, etc. We have discussed some of these biases in brief. These heuristics and biases can explain irrationality among investors and why they show biasness while taking investment decisions and creating a bubble in the stock market. The impact of these biases on investors' behavior and the market has also been discussed in the unit. You were listening to the audiobook by the School of Management Studies IGNOU for MBA program. Course code MMPC 014 Financial Management. Course coordinators Professor K. Ravi Shankar and Professor Kamal Wagricha. Voiceover by Harpreet Kaur. Edited by Savita. Program assisted by Tarannum Jahan and Jagbandhu Jana. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.